Welcome everybody to the Ultimate Advisors Resource Podcast. I've got Madeline Nelson here, our marketing director. I've got myself, obviously, Jordan Pence, and our company is Advisors Resource Company. We help advisors deliver more value to their clients in the life insurance and annuity space. And today we are going to talk about two retirement nightmares.
Retirement nightmares, because it's Halloween. Happy Halloween, everyone.
Yeah.
It's the pumpkin. I wore my orange. Jordan, I see you dressed up as well.
Dressed up as myself, and we've got two of them.
Okay.
And I think the idea here was just to give some things for people to think about. The first one, the vanishing nest egg. I prefer to call this the sequence of return, but it's a good point to talk about with your clients when they're entering retirement. So I think this is a great topic. It's very timely. There's a lot of insurance strategies or insurance products and even investment strategies outside of insurance products that you can do to mitigate this. And then the second one is something that we run across very frequently in the life insurance space, and that is phantom gains. So
I like that.
I do too. I think, well, I don't like it because it's really bad for the client, but I like it in the sense that it's a good talking point. It's a good thing to keep in mind. It's a very huge mistake that some people have made and could make. So let's I guess start it off, Maddie.
Yeah, sure. So with sequence of returns, we just recently kind of talked about this at an event we did, and it was really interesting. A lot of people were surprised by the outcome of this. So for people that aren't really familiar with this, can you kind of explain what sequence of returns actually means and why it's kind of a silent threat for retirees?
All right. The reason why we think this is such a big threat is the market's been ripping over the last 5 years, right? The S&P has basically doubled or more since 2020. And everybody's feeling great. Even the dumbest investor that just threw a dart at a dartboard and picked a random stock is killing it, right? They doubled their money. They're getting 20% every year. Everybody's talking about how great they're doing, and they're the smartest investor in the world. That's fantastic. And if you're in the accumulation phase still, if you're still accumulating wealth, you've got 20 years until retirement, that's fantastic. Just keep doing what you're doing because the market – nobody, I should say, really knows which direction the market's going to go. Who could have predicted 2020? I guess some people might say they could have predicted 2008, which was a long time ago, with the financial crisis. But you really can't predict sort of the ebbs and flows of the market.
Right.
However, when you're in the accumulation phase, it's not really that big of a deal. And I've actually got a demonstration of this. I'm going to try to show it on the screen behind us. I don't know if it'll display very well, but
I think it will.
Let's just try. So this example is like if you're in pre-retirement and you have a $100,000 portfolio, and let's just say you got 40% in the first year, 20% in the second year, 0% in the third year, negative 15 in the fourth year, and then negative 20 in the fifth year. Now, if you do the math and work that out over that 5-year period, you know, you start with 140,000, it goes up to 168,000, stays at 168,000 because you got zero, goes down to 142, and then you end up at 114,000.
Okay, way less than what you started.
Well, it's more than 100,000 at least.
Yeah.
But the point of this is not to, show you these returns and what they add up to. The point is, if you're not taking any money out, and I flip these returns, so if I just flip them around to get a negative 20, negative 15, 0, 20, and then 40, what do you think the results are going to be at the end of it? And I know you already know the answer.
But everyone in the audience was like higher, lower,
everyone was all over the place.
Advisors, financial advisors.
Yeah, exactly. And so the point of this is if I flip these returns around, you get the exact same results. So I don't know if anybody can see my screen, but if I do negative 20, negative 15, 0, 20, 40, I end up going down to 80, down to 68, stay at 68 because I got 0. I get plus 20, so I'm back at 81, and then plus 40, I'm at 114,000. I'm at the exact same results regardless of the direction of regardless of like the sequence of those returns, basically. I
Right.
could do the complete opposite.
Right? High one year, low the other. It doesn't really matter.
It doesn't matter at all. Where it matters, and in fact, if you're in the accumulation phase, you're probably still adding money to these accounts. So that makes the order of returns even less important because you're dollar cost averaging, right?
Okay.
Dollar cost,
don't know what that
most advisors should know what dollar cost averaging is,
Yeah,
but
I
basically you're putting the same amount of money in every month or every year.
Okay.
And because you're putting the same amount of money in, you're buying more or less shares depending on the value. So like if a stock is worth, if it's currently $100 and you're putting $100 a month in, okay, you buy one share the first month. Okay, if the next month it goes down to $50, now you're buying two shares.
Okay, so you're just buying what you can afford essentially with your payments every month.
Well, yeah, but I'm kind of doing a weighted average there. So now, the average cost of share essentially goes down because I bought two at 50. So I spent $200 and got three shares. So you get the
I
idea.
see.
Anyways,
That's pre-retirement. Do we have the other example too?
so the point of this is there's no difference between the two. Now, in post-retirement, the example that I gave, same returns, except every year we're going to take $6,000 out.
Right.
And if I get the positive returns in the beginning, it looks like this. I'm going to put it up on the screen, but the point is I went from 100 to 140, and then I took 6,000 out. I went down to 134. I get another 20%, so it goes up to 161. I take $6,000 out. It's down to, 155 basically. I get 0, so I'm still at 155. I take $6,000 out, so I'm at 149. Now it goes down 15, so I'm at 126,000. I take 6,000 out, I'm at 120, and then I lose 20% again, so I'm at 96, and then I take $6,000 out, I'm at $90,000 at the end of those 5 years. What if we flip it, right? So what happens if we flip it? Are the results going to be the same?
Let's find out.
So I'm gonna accelerate this because if you're listening to this, this is probably pretty boring.
Right, I was thinking that too. A lot of numbers right now, but it's
If you're
really
watching
quite
it,
interesting.
maybe it's interesting. I
Yeah.
don't know.
And if you can't see it on the screen, let us know, and we'd be glad to send it to you.
Yeah, we could actually put it in the download.
Sure.
We'll
Yeah,
put
it can
this
be
in
in
the
the description.
download. But anyways, so if I flip the returns around to where you get negative 20, negative 15, 0, 20, then 40, and I take the $6,000 out, the results are quite different.
Right.
In fact, I already have it up on the screen, but the first year you start out with 80,000, then I take $6,000 out, I'm at 74,000. Next year I lose 15, so I'm down to 63,000. I take $6,000 out, I'm at 57,000. I'm at 0 again, so I'm still at 57,000. I take 6 out, so I'm at 51,000. Now I get plus 20. I'm at 61,000. I take out $6,000, I'm at 55,000. And then I get 40, I'm at 77,000. I take out $6,000, I end up at 71,000.
That sucks.
That's a $21,000 swing just because of the sequence of returns.
Right. Well, when you're withdrawing that 6,000 every year, it makes a much larger impact.
The sequence matters a lot more when you're taking distributions rather than when you're not taking distributions. And so I think the point of all of that is when you're talking to clients and so forth, you really need to highlight this risk because their bias currently is in the fact that the market's been crushing it over the past 5 years, and I'm getting 20% in my accounts. Well, that's great, but is that going to continue, and is it going to continue for a long period of time is kind of the question there, right?
Do we have any
So,
Zoom questions on our Zoom Live?
I don't think so. Let's see.
Oh, I don't think it'd pop up.
No.
No, not yet. Okay. I guess does that kind of answer the next question? How can two clients have the same average of return over time, but end up with dramatically different outcomes in retirement?
It's all about the sequence of returns. I mean,
Right.
if you're taking distributions and you start off with a negative return, you've got a huge, huge problem. And so there's a lot of different approaches to this, to solve this. I think there's a lot of insurance options, including indexed annuities, fixed annuities that can provide decent returns and protect somebody's money.
Right.
And really just incorporating that as maybe even a bond alternative. So
Oh, okay.
I think that can be a good way to mitigate some of these. I think what I really want to highlight is just advisors need to highlight this risk to their client and really demonstrate it. Because again, people's biases, if you talk to people out there, it's like, my stock portfolio is doing great. Why would I change?
All right. So what's the solution to this? I don't really, is this even avoidable really? Or what can they do just to help?
If somebody's about to take distributions from their account, you got to really think about how they're allocated and mitigate some of that risk.
Right.
Currently, we see index annuities, they have very high caps, 9-10%.
Mm-hmm.
We have multiple year guaranteed annuities that are getting 5+%.
Mm-hmm.
And this is as of October, November 2025. Obviously, these rates change. It's a unique time for people entering retirement. And there's a lot of stats out there, but essentially we have the most people ever retiring or turning 65. I think it was this year or last year. I can't remember now,
That's
but
true.
we have had the most people retiring recently. So it's just a unique opportunity to talk to your clients about repositioning assets, and the solutions that we have may not be appropriate for your clients, but we've got plenty of indexed annuity options, fixed annuity options that could protect from some of these downturns while still providing returns that are going to outpace inflation.
Right. And I think that completely answers my next question about how can other tools like annuities or cash value life insurance play into stabilizing retirement income. So
If
it's
somebody,
just that.
if somebody's about to retire, it's a little bit too late for any index products or cash value life insurance, right?
Yeah.
It's more of a planning tool that you need to put in place when you're, like 10 years before retirement or something like
Right,
that.
right.
So for this, someone who's thinking about it now, there's no reason you can't use life insurance, but you could use annuities. Now, on the flip side of that, if you have clients that are more in the accumulation phase, they should be thinking about this, and for some of their money, allocating it into, or starting to allocate it into, or put money into index life insurance policies and things like that can have a dramatic impact. There was an EY study. I don't remember when it was done, but we'll link to it. It's a big,
Sure.
long document. We can link to it in the description.
What was it?
An Ernst & Young study that went over the fact that essentially if clients had somewhere between 20 and 30% of their net worth in fixed index annuities and or index life insurance, the amount of income that they could take out of their portfolio was higher, and the amount of legacy that they left to their family was higher.
Wow.
So, and that's from a company that doesn't even sell life insurance or annuities.
Interesting.
I will, I'll get you that study
Yeah,
and
sure.
put it in the description, because I think that's a very interesting study. Now, I don't know that I would give it to clients because it's quite long and it's,
Right. They don't want to.
yeah, you don't want to read it, but I would definitely take pieces from that study and share with your clients. I think it's a really interesting study. And it was basically when you combined, traditional stock market investments and equity investments with a fixed index annuity and life insurance, you got the most optimal outcome.
Right.
And that's based on Monte Carlo simulations and things like that. Obviously, there's going to be outliers where, having it all in stocks is going to be much better than the alternative, but that's under
Right.
all of the potential outcomes you end up with the life insurance.
But when you're
work.
speaking realistically, it makes more sense to
Why wouldn't you hedge?
mix, right?
Yeah, why wouldn't you have the mix just to hedge? And that was the point of the study. That was kind of
Yeah.
what they were talking about.
So essentially, it's a nightmare when you don't plan for retirement and you're not proactive about it because it's going to be too late if your client's already old.
Exactly.
So-
And what I was saying about the IUL, if you take a step back, and that's why I brought up the study a little bit, it's a great planning tool, even if they're in the accumulation phase. Again, if we're talking about 65-year-olds, it's a little bit too late.
Yeah.
But 55 and younger that have the time to start accumulating some into an index product, one strategy that is extremely popular to talk about, I'm not sure how much it's implemented, but I think it makes sense, is to use an index universal life policy as a portion of your portfolio. And the reason why you do that is when the market goes down, and this helps you avoid the sequence of returns. When the market goes down, take your income from your IUL, and I could also say, or your fixed indexed annuity, rather than your portfolio, to give your portfolio time to recover.
Okay.
So any of these insurance products could essentially, allow you to stay more aggressive in the rest of your portfolio. Does that make sense?
It does make sense, yeah.
Was that too much detail? Did I
No,
bore you with that?
I think I was getting it. I hope they were getting it. But okay, yeah, that pretty much kind of reminds me of the Kyle Busch thing we were talking about earlier. Should we bring that up briefly? We don't know. We have other things to talk about, but that's hot right now. What's going on with
Yes.
that? Would you speak on it a little bit?
Yeah, what's amazing? AI is like good and bad, right?
Oh, is this where you got your source?
No, well, I didn't get it all from AI. So what I did
Okay.
was I was having trouble finding the lawsuit
Right,
documents.
yeah.
So I told the AI, I said, do deep research and find the actual documents, because all I was finding were all these articles, and all the articles are pretty bad. Like the articles are talking about how tax-free retirement is a ripoff, IULs are a scam, and all this
Uh-oh.
stuff.
That
And
doesn't
so
sound good.
I got the 50-page document, and I don't know if you want to link. We could link to it in this, but
Sure.
we're going to do another podcast
Next
on
week.
it, go into more
Alright.
details. But if you read the actual lawsuit from Kyle Busch to Pacific Life and the agent, essentially what happened was the agent designed the policy in a way to maximize the agent's commissions. And so they did not use minimum non-MEC. In fact, the premiums were equivalent to the target premium, which is the commission premium. And that's basically how you max out your compensation, is you maximize the commissionable premium. And so the death benefit was way too high to accumulate any cash value.
Right.
And it gets worse. In like 2 or 3 years after the initial policies were issued, the agent went back and exchanged them for the new version of the same policy. So he doubled up on his commission
Oh, double dipper.
and did the same thing. So he made the
That's
policy.
some dirty work.
I mean, he probably made at least a couple $1 million off this sale and totally ripped off the client. Now, to be fair, in the lawsuit, the Pac Life reps were like emailing the clients, telling them how great of a deal this was.
Really? Everyone was in on it.
Well,
Maybe they didn't realize, though, how bad it was.
I don't know. So, and who knows what the agent told Pac Life, but this agent has been he was in legal trouble, and he had all other types of like red flags, basically. So, anyways, this is not a case of IUL bad. This is a case of IUL was used to scam a client. It was missold.
Right.
And misrepresented by the agent. And what's really messed up about the whole thing, what really pisses me off, is the articles are so heavy-handed talking about how we're worried about America getting ripped off by these products. Well, we should really be worried about greedy agents like that
It's the
giving
people behind them.
giving us a bad name.
And
it's
that's
ridiculous.
true in any industry.
Exactly.
I mean, any industry can take advantage of what they're selling.
Exactly. You could go to used car lots, you
Right,
could,
exactly.
I mean, you
It's
could
just exactly the right example.
you can get ripped off anywhere, and the fact that they're saying it was, or blaming it on the product, that's like a used car salesman sold me a crappy car, and then you say, you know what, all Fords are bad.
Right. Right.
mean-
That's why all the news articles are twisting it. They're twisting
Yeah.
it wrong. So we're going to debunk it next week.
Yeah, it really makes me
All
mad
right,
if you
we're
can't
gonna debunk
tell.
it. But anyways, we should move on to our next segment so we
Yeah.
can wrap
This
this up
is
a little
another
bit.
thing that grinds my gears. No, I'm just joking.
Okay, so we're going to talk about phantom gains. So can you
Okay.
kind of define that in a way that me and the advisors can understand?
So, phantom gains or phantom taxes or whatever you want to call it are associated with a life insurance policy when it has a loan that, like, let's say your cost basis in the policy is 100,000. You put in 100,000 of premium and you have a loan balance of 200,000 and your surrender value goes to zero and you cancel the policy.
Okay.
If that happens, you will pay tax, you'll pay income tax in that year on the difference between the loan balance and the cost basis. So $100,000 of taxable income in the scenario that I just gave. So if you have $100,000 of cost basis, $200,000 loan, and you cancel a contract because it's got no cash value, you're like, I don't need this insurance anyways, I'm just going to cancel it, I don't want to pay for it. That year, 2025, if you did it right now, you're going to owe tax on $100,000, even though you didn't get anything.
That sucks.
That's
So
what
why not
phantom.
just keep it if you were going to?
Well, this is the problem. So this could happen in a universal life policy, but personally, I've only really seen this happen in whole life policies. And what happens in the whole life policy is client will pay the premiums for whatever, 10, 20 years, right? So they've been paying their premiums every year. And they built up a lot of cash value, and they'll say, you know what, I don't feel like making the premium payments anymore. So they don't pay the premium payments. Well, the policy will then go on automatic premium loan, which could be a good thing. I'm not saying it's
Okay.
bad. I'm not saying it's good. Really, it's a insurance feature, right? So goes on automatic premium loans, and so if the premium was like, let's say $10,000, the insurance company loans $10,000 to pay the premium. Okay?
Right.
So let's say that happens for another 20 years. You're 40 years into this policy. You put in 200,000. Well, now you've got that loan balance.
Right, you have to pay it back off, but is
Well,
it the
maybe.
insurance paying it off?
What we've seen happen is that loan balance starts to grow faster than the cash value because some of these old whole life policies have poor loan features, 7, 8% loan features. Now all of a sudden your loan balance is going to eclipse the actual cash value and your policy is in danger of lapsing. And you might have not taken any loans out of the policy. One of the worst ones I saw was like a $900,000 loan balance. Surrender value or net cash value was under 100,000, so like somewhere around 50,000. And the client was like 80s, somewhere in their 80s. And so their options were repay the loan, let the policy lapse, and get, it was like a $500,000 or $600,000 taxable gain, and they'd get $60,000 back.
Okay.
You get what I'm saying?
Was there another option? Or?
Well, they could die.
Okay. So is that the best option in this
Yeah.
case for them just to die? Because that's pretty crap.
No, but it's not good at all. It's really bad. Like, and I see quite a few of these. Quite a few is maybe a stretch. I see a number of these, and where I see them the most, to be honest, is clients that work with fee-only advisors, and they did this insurance a long time ago. Because usually, if an insurance like an advisor that writes insurance gets a hold of a client and they have an insurance policy, especially an old whole life that's underperforming, they'll usually replace it. So this problem kind of goes away.
Okay.
Where I see it the most is, like I said, the fee-only advisors where they don't really do insurance. They see a whole life policy. They're like, okay, this is guaranteed. I don't need to worry about this. And that's where the danger comes in.
Right.
And again, this example, I'll go back to it because it's a scary example. $900,000 loan balance, $50,000-$60,000 of surrender value,
Yeah.
cost basis of $200,000 or $300,000, $400,000, whatever it was, it doesn't really matter. So if they canceled it, or if they let that cash value go to zero, the client's going to get whatever it was, 500,000 or 600,000 of taxes that they would owe, and get like nothing back, basically.
It sounds like a nightmare. That's gonna keep
It really
you up tonight.
is. I mean,
Happy Halloween.
it's
Don't let that
really
get you.
it's really bad. And I'm not saying whole life contracts are bad.
Yeah.
If Ralph, my father, was here, he'd say whole life is bad. But
He's gonna be on next week. Ask him all
yeah,
about it.
we can ask him about it. But I don't think it's necessarily bad. What's bad is the agent and the client, let's say, to be fair, didn't keep up with the policy and didn't understand the consequences of what was going on. Current universal life policies do have this same problem, but a lot of them have built-in overloan protection riders. And an overloan protection rider effectively prevents this problem from happening. It could still happen because the client could manually choose to surrender the policy, but it's not going to occur because they took too much money out, the loans grew too big, and then the policy didn't have enough cash value in it. Right?
Right.
So there's
But-
some protections with universal life, but the whole life, I've seen those. I mean, and I'm not trying to dog on whole life or anything, but
Sounds like you are.
yeah,
But
even though it is a dog.
it kind of just comes down to the advisor, though. I mean, it's not the client's responsibility to know all the odds and outs of this thing. So
No,
the
no.
advisor's
I mean,
responsibility.
these products are way too complicated.
they are.
And I will go back to the Kyle Busch thing. That product that he bought was the Pack Life PDX product, and that was extremely complicated. And it had some material problems, but I don't think that even really matters because the agent really just ripped him off. But
Right.
that's
I mean, he didn't fully understand it. He got taken advantage of. And
Yeah.
so that's a real issue, and that's probably going to cause a lot of suspicion in the eyes of clients. Like, clients are now
it
going to be
should.
more suspicious than ever of who are they trusting with their money. And it's kind of relevant to the episode we did last week with Susan Bryant. She talked about
yeah,
you
look
know
up
what
the
people are searching you online. They're searching you on these websites, and you know, you want to make sure you implant trust.
I mean, I
you know, in the heart
background
of your
check
client.
employees.
Didn't background check me. But I think something really important that she mentioned was when they look you up, if they do find something like a red flag, address it. You know, it
Yeah.
might be not be a non-issue, but if they see, hey, they have a mark, what was it called? Can you remember?
U4 on their
yeah,
U4.
Yeah, so if you've got that on there, address the issue with them because they're going to find it and then they may not trust you.
Yeah, exactly. No, I totally agree. And, you know, again, what really just frustrates me is the articles at least are trashing the product and the strategy of tax-free retirement, and their focus is on the wrong thing. And that's my main beef. Now, I will say again, that product from Pack Life was pretty bad, but
Right.
if it was set up properly and funded properly, it would have worked out just fine. Like, he wouldn't have lost $8 million.
Yep.
I mean, I had a client text me. It was actually, well, I won't say his name, but he texted me and was like, what's going on? Am I screwed? You know, because
Right.
he bought an IUL. And he sent me a
'cause
screenshot
he's
of
seen
it.
the news, and
I
that's
know.
everyone's seeing the news, and so
We're going to get an article out on this, and I don't mean to keep it's just fresh on my mind. I
Right,
was
it
thinking
just
about it
came
last
out.
night, and I'm going to put an article together that you can send to your clients, an article to advisors explaining this and explaining why the fake news is wrong again.
fake news.
Fake news.
Yeah. So
I
this is
know.
also going to make you look really proactive, and it's another reason to reach out to your clients and educate them about what's going on.
If you've sold them any type of index product, I will reach out to me. I will gladly give you a write-up to send to them. And you should probably do your future business through us if you haven't
course.
done it with us.
All right,
but
look how smart we are. Do you know
I know. Come on. Anyways, I think that's about it, man.
Yeah, I think. Do you have any other final thoughts on kind of whole life and when it makes sense? Any final thoughts on that?
I don't think whole life is necessarily bad. It's just like IUL isn't necessarily bad. So I'm not saying this phantom gain thing is a unique problem to whole life. It could be a problem to index life, traditional UL, VUL, anything like that. But what I'm saying is the real problem is follow up with your clients, do policy reviews, monitor it. Don't just sell it and forget it. I mean,
Right.
because it's even a whole life, as simple as a whole life is, it does, I mean, if they're going to make changes, it requires changes. So you need to think about that.
Right.
So that's my final thoughts.
All
And,
right. Well, thank you, Jordan. This has been very frightening. I'm, very scared for advisors and their clients right now.
you're really,
Taking it home on that Halloween.
yes,
game, so.
yes.
Anywho, thanks, Jordan. We're going to have a couple downloads with that sequence of returns chart if you'd
Yes.
like to see it further. Any other questions, please feel free to reach out to us. And I think that is that.
Yep. Thanks, everybody. Thanks for joining us.
Thanks.